Well, the next guest says he does not believe that we are on the cusp of a 2008-style financial crisis. In fact, he may use the downturn to add some big U.S. banking names to his client portfolios. John Zechner joins us now. He's chairman and founder of Zechner Associates. Thanks for coming in, John.
Morning, Paul.
Let's start with that first question. First of all, David showed us at least 6 U.S. regional banks that are down as much as 80%. You do not believe, however, we're at the beginning of a permanent contagion here.
No, you're right, Paul. Those specific banks are at risk. Their equity is at risk. I mean, what the government came out really today and said is the FDIC will protect the deposits in the banks, so the holders. This is not a contagion effect. I mean, this is not as pervasive as the housing downturn, as you talked about, that led to the great financial crisis. And the major banks are well more capitalized than they were back at that point in time. So, I think everything gets washed down in the carnage. I mean, the bank index was down, 8% on Thursday, Friday. I mean, that creates some opportunities. And I think you got to look for the winners versus the losers. This is very specific to, these. Yeah, you follow this well, Paul. I mean, when the pandemic began, it was all this initial lending as interest rates went to zero, and you had a lot of these startups who were looking for financing. Where did they go? They had these more aggressive banks that were going out there, and they were getting cheap zero financing. And effectively, they borrow short, they lend long. So maybe they lend it out at 3 or 4% to these new startups and all. Fine. And they wouldn't have their own deposit base or anything. They would go out and get commercial funding. Or some of these, once they lent this money, some of these guys like Roku would put X amount of the money back with them onto their balance sheet and all, which is fine. That worked as long as the interest rates were at zero. But as we've all watched for a while, we knew that something was going to break with the amount of aggressive tightening you saw from the Fed and the Bank of Canada and everything. And this is the first thing to break. Obviously, that lending is out there for these startups, and suddenly their funding costs are way up. You're not getting, free money. You're not getting money at even 2 or 3%. You're paying 5, 6, 7%. And you've lent it out long term at 3% to startup companies that have no capital, that have no earnings, and those things are all breaking down. So where's the opportunity? The opportunity is in the banks that have stronger deposit bases, and Canadian banks sort of fit in very well with that. The big U.S. players, J.P. Morgan, Bank of America, New York City, they're probably in very good shape. Their stocks get hit. I think there's an opportunity to get at it. The other probably potential winners in this, if you want to call it that, might be the big tech companies, because suddenly all these venture capitals, startups and all of that, if they can't get the funding, they may have to turn to the big players in order to get their apps or whatever developed. And these guys can sort of walk in, because that's the way a lot of these guys grow through their acquisitions of smaller applications and all that. So that's the landscape. So, we've been, as you know, Paul, I've talked about this, we've been pretty negative since sort of the downturn in January. We're sort of still overweight gold, still overweight bonds, and underweight tech and financials and others. But you know what? I'm ready to step back a little bit more into the banks on this. The only ones I want to watch, and you know more about this too, Paul, is TD and BMO.
I was going to ask about that. They're closing big acquisitions in the United States. And in some notes you shared with us in anticipation of this conversation, you say this is a red flag for both of those banks.
It's a little bit, because it's Bank of the West. I don't know as much of what deposit institution, what it was. I don't know what the risk assets were. I tend to think, the Canadian banks have always been very strong in the ability to diversify risk and contain that. So, they've raised the capital. I'm not overly worried about it, but that doesn't look good in the short term. And TD, quite honestly, I bet they're out there, talking with the First Horizon right now down in Tennessee. Maybe let's renegotiate this, because it hasn't closed yet, and there were some regulatory holdups, and maybe they can get a better deal. I don't know what the drop dead is or the breakup fee or anything like that, but that's probably the only risk I see within the Canadian banks. CIBC a little bit because of U.S. operations as well.
One reason that the U.S. stock markets aren't plunging appears to be this idea that the Fed may be at the end, or at least on the cusp of a significant pause in raising rates. What do you think we will see from the Fed?
Isn't that interesting, Paul? Because a couple of days ago, when Chairman Powell was in front of the Congress,
right?
The market got all worried last week. There's so many things to worry about. Last week, the worry was that the Fed's going to be more aggressive.
Because
rates are going higher.
Because he told them that would be the case.
Exactly. The inflation's not coming down as quickly as they want, and growth is staying stronger longer. The employment report didn't really put anyone's mind at ease either way. The inflation report this week, Paul, is going to be absolutely huge. I still think that, if the inflation report doesn't start to show a real break inflation, if it comes in at expectations or, heaven forbid, be a little above it, they're going to have a hard time saying we're stopping the rate increases at this point. You know, I was there to think before they go a half point, you know, maybe a quarter point now, but the bets have all reversed. There's a 50% chance now in the Fed futures that they don't move at all next week. I don't know. Let's see that report this week, but you haven't turned off that inflationary problem, and this is their only way to battle it. But like I say, they've raised them so fast, so hard that something had to break, and it did last week.
Good point. Last question. Would you go near the U.S. regionals at this point in terms of adding exposure to financials?
Why? Why would you step in there until you know they're not as strong on the deposit-taking side? Stick with the quality players. They're all at a discount. They've all gotten hit. I'd rather pick up there.